You have 500 to invest this month, maybe 1,000, maybe more, and you are staring at a dozen options. Should you max out your 401k, open a Roth IRA, pay off debt, build an emergency fund, buy index funds, invest in a taxable account? Every finance guru has a different answer. Every Reddit thread contradicts the last one. And you are paralyzed because you don't want to make the wrong choice. Here is what nobody tells you. The order matters more than the amount. Putting 500 in the wrong place is worse than putting 300 in the right place. There is an optimal sequence to investing your money. A hierarchy that mathematically maximizes your returns while minimizing your risk. And it is not the same for everyone. It depends on where you are financially right now. Today, I am going to show you the exact order to invest your money in 2026, step by step, based on your current situation. By the end, you'll know exactly where every dollar should go. Before you invest a single dollar, you need a foundation. Without this, investing is like building a house on sand. Step 1. Eliminate high-interest debt. If you have credit card debt, personal loans, or any debt above 7 to 8 interest, pay it off first, not after. Not alongside investing. First. Why? If you have a credit card charging 22 interest, paying it off is a guaranteed 22 return. No investment can reliably beat that. The S&P 500 averages 10 annually. Even if you got lucky and hit 12, you are still losing money by keeping debt at 22. The math. You have 500 to invest and 5,000 in credit card debt at 22. Option 1. Invest 500 month at 10 return, 102,000 after 30 years. Option 2. Pay debt with 500 month, then invest 247,000 after 30 years, paying off debt. First more than doubles your wealth. The rule. Pay off any debt above 7 before investing. Mathematically, it is the highest return investment you can make. Exception. If your employer offers a 401k match, contribute enough to get the full match first. We'll cover this in step 4, then attack high-interest debt. Step 2. Build a starter emergency fund, 1,000 to 2,000. Before you invest anything, you need a small cash buffer. Not 6 months of expenses yet. Just 1,000 to 2,000 to cover minor emergencies. Why? Without this, the first unexpected expense, car repair, medical bill, broken appliance, will force you to stop investing to cover it, or go into debt to cover it. Either way, you lose momentum. The rule. Save 1,000 to 2,000 in a high-yield savings account, earning 4 to 5 before investing. This is your financial airbag. It keeps small emergencies from becoming financial disasters. Step 3. Get the full 401k match. If your employer offers a 401k match, contribute enough to get the full match. This is the only true free money in investing. Example. Your employer matches 50 of your contributions up to 6 of your salary. You make 60,000. 3,600 per year. You contribute 3,600, employer adds 1,800. That is an instant 50 return before any market growth. The math. 3,600 of your money, 1,800 match, 5,400 invested. If you didn't take the match and invested 3,600 elsewhere, you'd need a 50 return just to match what your employer gave you for free. The rule. Always contribute enough to get the full match. It is the highest guaranteed return you'll ever get. Once high-interest debt is gone, you have a starter fund, and you are getting your match. It is time to build real security. Step 4. Pay off moderate interest debt. 4 to 7. This includes car loans, student loans, and personal loans in the 4 to 7 interest range. Why this order? This debt is costing you more than most safe investments earn, but less than the stock market averages. You are in the gray zone. The decision framework. If the interest rate is 6 to 7, pay it off aggressively. 4 to 5. It is a personal choice. Pay off for peace of mind, or invest for higher returns. Below 4, keep the loan. Invest instead. Example. Car loan at 5.5, Balance 8,000. Paying it off is a guaranteed 5.5 return. Investing in the stock market might get you 10, but it is not guaranteed. The conservative play, pay off the loan. You are mathematically better off in most scenarios, and you free up cash flow. The aggressive play, keep the loan. Invest instead, bet on market, returns exceeding 5.5. My recommendation for 2026, with market uncertainty and potential volatility, pay off debt above 5. Gives you flexibility and guaranteed returns. Step 5. Build full emergency fund 3 to 6 months expenses. Now it is time to build a complete emergency fund. Calculate your monthly essential expenses: rent, food, utilities, insurance, minimum debt payments. Multiply by 3 to 6 months, depending on 3 months, if dual income household, stable job, strong industry. 6 months, if single income, commission, based income, volatile industry. Why? This fund lets you invest aggressively without fear. If you lose your job or have a major emergency, you won't be forced to sell investments at a loss. Where to keep it? High yield savings account, earning 4 to 5 2026 rates are still decent. Do not invest your emergency fund. It needs to be liquid and stable. The psychological benefit. Once this is funded, you can invest everything else aggressively, because you know your baseline security is covered. You've eliminated high interest debt. You have an emergency fund. You are getting your match. Now it is time to build real wealth. Step 6. Max out Roth IRA 7,000 for 2026. For 2026, the Roth IRA contribution limit is 7,000, or 8,000 if you are 50. Why Roth IRA is next? Tax-free growth forever. You contribute after tax dollars, but all growth and withdrawals in retirement are tax-free. Example: contribute 7,000 year from age 25 to 65. Total contributions, 280,000. At 8 average return, 1.86 million at retirement. You pay zero taxes on the 1.58 million in gains. If this were a taxable account, you'd owe about 237,000 to 316,000 in capital gains taxes. The Roth IRA is the best retirement account for most people under 40. Income limits. If you make over 161,000 single or 240,000 married in 2026, you can't contribute directly. But you can still do a backdoor Roth IRA, contribute to traditional IRA, then convert to Roth. The rule. Max your Roth IRA every year before investing in taxable accounts. Step 7. Max out HSA if eligible. 4,300 individual, 8,550 family for 2026. If you have a high deductible health plan, you are eligible for an HSA, health savings account. This is the most tax-advantaged account in existence. Triple tax advantage. 1. Contributions are tax deductible, lowers your taxable income. 2. Growth is tax free. 3. Withdrawals for medical expenses are tax free. The strategy: don't use your HSA for current medical expenses if you can avoid it. Pay medical bills out of pocket and let the HSA grow for decades. At 65, you can withdraw for any reason, penalty free. Just taxed as income like a traditional IRA, or keep it for medical expenses in retirement, tax free forever. Example: max HSA for 30 years at 8,550 year. Family plan. Total contributions, 256,500. At 8 return, 1.03 million. All tax-free if used for medical expenses, which you'll definitely have at 65. The rule: if you are eligible for an HSA, max it out before putting extra money in your 401k beyond the match. Step 8. Go back to 401k and max it out 23,500 for 2026. Now that Roth IRA and HSA are maxed, return to your 401k and contribute up to the limit for 2026 to 23,500. 31,000 if you are 50. Why this order? You already got the match earlier. Step 3. Now you are adding extra contributions for the tax deduction and higher contribution limits. Traditional versus Roth 401k. If your 401k offers a Roth option, choose Roth. If you are early career lower tax bracket now, choose traditional. If you are peak earnings higher tax bracket now. The rule: if you can afford to max your 401k 3,500, your HSA 8,550, and your Roth IRA 7,000, you are investing 39,050 per year. You are on track to retire very wealthy. Step 9. Taxable brokerage account, index funds. Once you've maxed all tax advantaged accounts, what to buy? Low-cost index funds. Total Stock Market Index, VTI, Vermont Sachs, SP 500 Index, VU, VFIX. Total International Stock Market VEXUS, Vermont IAX. Asset allocation for 2026. Age. Based rule: 110 minus your age stock percentage. Age 25 to 85 stocks, 15 bonds. Age 40 to 70 stocks, 30 bonds. Age 55 to 55 stocks, 45 bonds. Tax efficiency. In taxable accounts, hold tax-efficient funds, index funds, and avoid frequent trading to minimize capital gains taxes. Step 10. Other investments: real estate, 529, etc. Only after completing steps 1 to 9s. Hold you consider 529 college savings plan. If you have kids, tax free growth for education expenses. Real estate. Only if you understand it and have time to manage it. Real estate can build wealth, but it is not passive and has high upfront costs. Individual stocks. Only with money you can afford to lose. Index funds beat 90 of stock pickers. Here is the complete order for 2026. Phase 1. Foundation. 1. Pay off debt above 7 to 8. 2. Save 1,000 to 2,000 starter emergency fund. 3. Get full employer 401k match. Phase 2. Security. 4. Pay off debt 4 to 7. 5. Build 3 to 6 month emergency fund. Phase 3. Wealth building. 6. Max Roth IRA 7,000. 7. Max HSA if eligible 4,300 to 8,550. 8. Max 401 23,500. Phase 4. Advanced. 9. Invest in taxable brokerage, index funds. 10. Other investments: real estate, 529, etc. Where are you? Most people are somewhere between steps 3 to 6. That is fine. You don't need to complete all steps at once. The key is knowing where you are and what comes next. Action item. Identify which step you are on right now. Focus all your energy on completing that step before moving to the next. Order matters more than amount. If this gave you clarity on where your money should go, subscribe. Most people invest randomly. You now have a system. Thanks for watching.